Yes, the unmistakable sound of Pink Floyd's Money means once more that it's time for the Okanagan Money Report, a production of Septon Financial and West Bank and District Community Radio Society, heard Saturdays and Sundays on www.wdcr.ca at 1 and 5 p.m. Pacific. The Okanagan Money Report is the radio version of Okanagan Money, now available at www.septonmoneymag.com. I'm your host, Chuck Jordan. Our executive producer is Robert Eager, and today's topic is the Electronic Traded Fund, or as it is known by its acronym, the ETF. This is a marketable security that tracks an index, a commodity, bonds, or a basket of assets in the same way that a mutual fund does. Unlike a mutual fund, though, an ETF actually trades like a common stock on the stock market. An ETF is a type of fund that owns the underlying asset. This asset could be shares of stock, bonds, oil futures, gold bars, foreign currency, or whatever. The ETF divides the assets into shares. As a shareholder, you won't directly own or have a claim on the underlying asset. Electronic traded funds are now available to investors in the form of life insurance segregated funds, an investment fund that comprises individual ETFs based on a specific basket of assets. As such, they combine the growth potential of a mutual fund with the security of a life insurance policy. Yep, ETFs in a life insurance seg fund offer investors protection from creditors, plus guarantees of principal protection and death benefit guarantees. But what differences can an ETF offer an investor, I hear you ask, as compared to investing in individual stocks, say? Well, stay tuned and we'll be right back with some insights. If you have just tuned in, you're listening to the Okanagan Money Report, broadcasting live on 95.1 WDCR and streaming live at www.wdcr.ca. And today's topic is electronic traded funds, or ETFs. There are a couple of important differences attached to investing in an ETF. The first is that it exposes investors to a global macro investment strategy. This means, rather than looking at the internal workings of individual companies, ETF strategy is based on exposure to whole asset classes. The second and kind of related difference is that because of their global nature, electronic traded funds give Canadian investors the chance to break away from their home bias and to think globally. Different types of life insurance seg funds use different combinations of ETFs to match investor needs. And there are basically two types: passive funds and actively managed funds. A passive fund is where the holdings in individual ETFs are fixed. Examples of passive funds are those offered by a major insurance company designed to match the investment objectives of investors, whether it be capital preservation, income generation, or long-term growth. For example, a fund dedicated to preserving your capital is composed 90% by value of individual ETFs comprised of fixed income securities like bonds, and only 10% based on stocks, or equities as we call them, the majority being stocks of Canadian companies. Passive funds such as these have fixed proportions of ETFs. Fixed income versus equity, government bonds versus corporate bonds, Canadian securities versus US securities, etc., etc. An actively managed life insurance segregated fund does not have fixed proportions of individual ETFs, but rather is continually trading in individual ETFs and changing those holdings to access growth opportunities around the world. These holdings are added to, reduced, or gotten rid of altogether as those opportunities shift and change. To find out if electronic traded funds are a suitable vehicle for you and how they could work for you as part of a life insurance segregated fund strategy, contact us through www.septonmoneymag.com or call us at 778-753-2020. This is Chuck Jordan, your host for Okanagan Money Report, signing off and saying thanks for listening to today's Okanagan Money Report.